All right. Well, welcome everyone that has joined today. It's tough for some people, given that it's the holiday weekend, but I appreciate you guys stepping up to join the call this week. Let's just kind of jump in. I'm going to share my screen here. Um, and you guys can ask questions along the way. Don't feel like you have to sit here and listen to me talk. Okay. I want your participation because there's going to be probably some not necessarily confusing aspects of what I'm telling you, but some of you are a little bit more further ahead in the game than some of the other folks. So there might be a term on there that someone doesn't understand, or they don't understand how a particular process works, or why we're asking for what we're asking. So please participate as we kind of move along here. Let's see here. All right, you guys see this? Yeah, you guys can see the screen. All right, all right. So how to get equity? So this conversation can really be used for uh, any equity provider out there. Um, I'll get into the more specific aspects around kind of what we're looking for. Every equity provider is going to have some differences in what they're looking for in terms of deals, whether it's the industry, whether it's the size of the business, whether it's kind of the structure of the deal going in. There's a whole host of requirements that every particular um, equity provider will be looking for in any deal that you submit to them requesting an equity investment. But there are some things that I think there's one aspect of the process that you guys need to take care of on the front end before you go looking for an equity provider, because that equity provider, some are going to invest under certain, what I would call certain assumptions about your ownership that are different than other equity providers that are going to invest based on other assumptions about your ownership. So what I mean by that is determine kind of what your role is in the business, what you plan to do. If you're a passive equity investor, okay, that's not going to be something that Acquira is going to fund. We're not looking for passive equity investors. We're not going to fund that. There's a whole bunch of other equity providers that won't fund it, but there's a whole bunch that will form it, that will provide equity in that type of deal. Us specifically, we're looking for owner operators to start with. Okay, all right. That means one of the two areas that I've highlighted in green. Are you coming in as a structurer? That means you're a person. Basically, that's an AE buying a business. You're going to take over, change the operations, improve them, all the stuff that we talk about in the training. Okay. Um, those are the types of people we're looking for. Are you a AE that owns a business and you're rolling another business into that business and it makes sense? Okay. Those are the types of equity or the type of equity we'll provide in a transaction. Okay. Portfolio manager. You know, we talk about this all the time. What do you want to do? Are you doing a roll up? Are you doing a holding company structure? What have you? We get into these discussions around that, and at some point, you may become a portfolio manager. But if your whole purpose is to come in from the get go, and you're just from the start, you're going to build this whole co, and you're just going to be a portfolio manager where you're just going to allocate capital to, management run businesses or what have you. That might be appropriate for some other equity investor. It's not appropriate for us. Okay. We're investing in you as AEs. And so we want to see you actively involved in the business. And you can't really do that as a portfolio manager until you've spent some initial time in the business. It's highlighted in yellow because at some point we will fund those deals for you. But of course, your very first deal with us, we got to, you have to build confidence, or we have to build confidence in you, or we have to have confidence in your ability to actually execute on owning a business. So that means you're an owner operator, at least for that first year, for that first 12 months. Okay. Thereafter, you can start to move away from that. But in the beginning, you've got to be there full time. Okay. You've got to be operating the business. We've got to understand that you know how to operate a business. And then once we have that confidence in you on your next acquisition, maybe it's a situation where it is a portfolio acquisition. You're adding it as some sort of a, diversified acquisition that's going to, spread your income, your investment amongst different industries. we might have a little bit more faith that you can do that if we've seen you operate a business. So that's why that's in yellow. It's kind of like, yeah, we'll do it, but we're not going to do it up front. Now, apprentice coming in as an apprentice, and what that is just a person who's going to necessarily buy a business and have other, the current management team running the business as they kind of sit and learn the business. I mean, it's not a bad way to buy a business, but again, we're investing in you. We're not really looking for owners to take that role. That role might be appropriate in a business where you have no experience. You can buy the business on your own. You don't need our capital. You're making a small initial investment in the business, and you want to learn the business before you take it over from the seller. Um, that could be an appropriate strategy, but it's not something we're going to fund. So when you come in, and usually when I talk to new AEs coming into the business, first thing I have them do is do an investment thesis, and part of that investment thesis is kind of lay out what your goals are from your acquisitions, what you plan to do, how you plan to operate the business, kind of just some longer term thinking around acquiring the business. Okay, it's important because again, if you're looking for capital from us, we're not looking to fund passive investments or part-time opportunities. This is not what we do. We want you guys actively in that business, running it. And then, of course, the whole purpose of ACE is to help you build a management-led company. Okay, so that's why we require it when we're talking about doing an equity investment. Is you have to have ACE with it. Okay, because that de-risks our it kind of de-risks our beliefs in potential operational failures. So from that standpoint, we want to get you to that point where you can kind of sort of slowly step away, but not initially, because then initially, even when you're working with the ACE team, you're on the ground with them, you're working on the business, and you want your employees to know who you are the first 12 months. You want to know the business inside and out, because even if you hire a GM down the road, you don't want that GM being able to take advantage of you because they know the business better than you know the business. Okay. So just keep that in mind. All right. Now let's get into some specifics because I know that's what you guys really want to know. All right. So what are we looking for? Okay. Now let's talk generally. So we talk about the fund providing up to 80% of the equity required in any transaction. And that basically means that yes, we're funding 80%, but we're funding it in a structure where we own basically from the get-go 0% in terms of decision making in the business. It's a preferred equity structure to start with. So we don't own any common shares. You still are making all the decisions around the business. You own basically 100% of the business technically from that standpoint. And so I just so you guys that are new understand kind of how that structure works. Yeah, we don't take even though we're putting up a substantial piece of the equity, we don't take any majority ownership in the business. We do have conversion rights down the road. Okay, once the SBA loan is paid off. But for the time being, up front, you're making all decisions in the business, which is why when we make an investment, I say we're actually making an investment in you, and we want you on the ground there. It's because our money, we don't have any decision-making authority around that. You do, so we have to believe that you can actually execute. So that's why I kind of wanted to preface this from the beginning that a lot of our investment is in you personally as AE. So, okay, around that. So what are we looking for? We're looking for licensed, high-skilled, trades-based businesses. Okay, either in home services or manufacturing. Some of you guys would probably be shocked that we're looking in the manufacturing space, but that's kind of where Chris's expertise is. And before Chris joined Acquira, Acquira's expertise is in the home services space. So we kind of combined the two. Now, what that means, even on home services, the business could have a commercial service component to it, or it could be a commercial service business that has a pathway to becoming a home base, or home base. That sounds like MLM, home services type business. So what we're looking for, obviously, the usuals that we talk about all the time: electrical, plumbing, HVAC. I would say stone businesses, and for some of you who don't know stone, don't understand what a stone business is. Business that basically think hardscaping. They put in stone. They service stone. They install it, service it, that sort of thing. And then obviously roofing. Not a favorite of ours right now, but we'll still consider it. Now, beyond those five, though, obviously within there, you've got some other kind of trades related construction type businesses that we'll look at, patio installations, certain pool installation. I think we're still, like pest control, like type services, anything servicing the home. But ideally, you guys got to think about it from this standpoint. If I buy a business that's servicing the home, can I build a recurring revenue strategy around that through some sort of a maintenance contracts or warranties sold or what have you? We're not really looking for project related businesses. They could be project related businesses, but you have to be able to articulate some sort of recurring strategy around that or think about that recurring revenue, because projects can be one off. So you could have 1 year where you do $30 million a year in revenue, and then you don't have another project for 3 years. Okay, so obviously you're going to be in a situation where your loan's going to get stressed if that happens. And I know I'm being a little bit extreme, but you guys get the gist. Um, Around manufacturing, what are we looking for? Okay, we're looking for prototyping job shops. Those are kind of like one-off or low volume prototypes of different types of products and services. So, like, maybe a customer comes to you as a contract manufacturer. They want you to do a specific job. We like those opportunities. CNC manufacturing businesses. We love those. Now, as far as like what these are, we can get into them. I can get into, we can get into some specifics, not on this call, but if you have questions about what's wire EDM, or what's a lathe, or what's a lathe manufacturer, or what's a mill manufacturing company. We can have those one-off discussions. If you find a business and you're like, well, what is this? Does this fit with the category? We'll talk about it at that point. PCB manufacturers, which are printed circuit boards. Some of you guys know I own a company like that. That's not why Chris wants to invest in those. He actually owns, I think, a company like that as well, and he likes that business. AS 9100D or ISO 9000 level optics manufacturers. Now, those are going to be manufacturers that are manufacturing parts in the aerospace and defense generally. We actually like those businesses. So if you come across any of those opportunities, we're interested in that. And then niche manufacturing for any products that have some sort of a competitive moat around it. So we've kind of opened up the spigot a little bit in terms of the investment types. But just kind of at a high level, we still love the trades businesses. All of these are still trades businesses because you're going to have high skilled people working in these manufacturing facilities in addition to home service trades. So, we're still focused on the trades. We've just kind of opened up kind of where those trades are actually employing their skill sets from that standpoint. You guys have any questions around this first slide?
I guess I have a trip here. I'm doing the Done With You service with you guys. And so just a question on the manufacturing. Are there any areas that you're more like, we say like you're saying roofing is not a favorite. Is there some areas that you think are more promising with manufacturing or less promising? Like, how are you guys thinking about that?
Honestly, I probably shouldn't have said roofing not a favorite. I would say roofing. I'll answer that question first. So specifically around roofing, it's a really specific. It's opportunity focused, because there's roofing companies can be structured a couple of different ways, and there's certain roofing companies that are structured certain ways that we definitely don't have an affinity for. So, for instance, if you think about a roofing company in Florida, which is just more or less a sales and marketing type roofing opportunity where they don't use their own employees, they're using contractors, and they're going after, and they're basically storm chasers. They're making all their money when there's big hurricanes that come through and they don't make any money thereafter. Probably not something we're interested in. Whereas maybe you buy a roofing company in Nevada where, they've got a full staff and they're offering special coatings and maintenance agreements around those. There's not a whole lot of natural disasters happening in the space or in that particular area. So we know that the income's consistent, the cash flow's consistent for the most part. Those we're interested in. So I wouldn't say it's not a favorite, but generally what we've been seeing based on a lot of the roofing companies we have been seeing. It's probably, and this is my personal opinion, it's probably fallen out of favor, just in how we look at it overall. As far as industries that are favorites, that are in favor or not with us, we don't really look at things that way. Everything's based on the opportunity set in front of us. So if there's a company that's in an unfavorable industry and that's still producing, that's favorable for us. It's not, we're not taking a macro view based on what's going on with, the Fed or, the larger
Right.
economic the larger economic events, except around, like, if you have a business that's heavily involved in construction and the real estate market is just crapping out, then obviously we're
Right.
going to consider that and we're going to try to figure out ways to mitigate that risk. But that's not to say we still won't invest.
Yeah,
Um,
no, that makes sense. I guess one of the other questions that I would have is, I mean, I have a background in, I worked for Amazon, and we did like I was the kind of the technical program manager for like a very large kind of beginning to end manufacturing of devices and those kind of things. And so that I'm just curious, like, do you see unique opportunities that people aren't thinking about in the manufacturing sector that you think, hey, people should be asking more questions about this and looking more into this? Like, how are you guys thinking about it?
well, yeah, that last line there, niche manufacturing for specific products. I mean, I think the way you look at manufacturers are around, mostly around niche products. If you find a manufacturer that's doing commodity based products, it's
Mm-hmm.
probably something, that's not worth taking a look at, because you're going to have some scale around that, and you're
Right.
buying a small business. So, if you're buying a small business, if you're competing with a larger manufacturer that's doing a lot of commodity products, you're going to get you're going to get killed or crushed. So I think if you're looking kind of specifically in the manufacturing space, you just want to find unique products. I mean, anything that's like really unique, that a small business has a competitive advantage around, or that's been created by that particular business owner or seller or what have you. I think is the way to go around manufacturing.
Okay.
Yeah, I mean, if you're looking at something that's, like somebody's processing, okay, this is being stupid, but they're processing transistor radios. I mean, yeah, they might, but maybe they've got, so, they're making some cash, but, because there's a market for, like, old radios or whatever, but, it's probably not something I would probably take a look at. But I mean, unique products is mostly around manufacturing at this small of level. It's going to be mostly about unique products or some competitive advantage around distribution. So maybe they might manufacture a product and they've got this really great distribution model that no one else
Mm-hmm.
can tackle or copy, or that hasn't at this point. That would be something that would be interesting and people should really kind of take a look at.
Okay. Thank you.
Yep. Dean, go ahead.
Hey, so you probably get that question a lot, and it's kind of the opposite of what he was asking. If we do have a really good, like I love the electrical, plumbing, and HVAC companies, and again, I know you probably think about it all the time, but if it's solely into industrial and commercial, what are we looking for to see like, okay, that we're okay with this?
You mean Acquira?
Yeah, sure.
Yeah, I mean, again, if it's a service company, and it's all commercial, industrial, I'm not gonna say we won't look at it. I'll say this: there could be a situation where if the fund itself doesn't fund it, if we find it a compelling business, we may, at the corporate level, consider funding it.
Still
I mean, we're,
dependent.
yeah,
Mm.
independent of the fund. So just so you guys understand, Chris is the chief investment officer of the fund. He makes the ultimate decisions. Yes, I have some sway with him to a certain extent to sell him on deals. That's part of my job when you guys are, pitching deals, and coming through the coaching part of the business. It's my job to actually sell him on the idea. Um, so I do have a little bit of sway with him, but for the most part, he's really going to be looking for, if it's service related, he's going to be looking for a way for that business to have some path to profitability by selling into a larger addressable market, which is going to be your home market. Now, again, if it's a compelling business and we like it, acquire a corp, we may, put the money together or, invest out of our own coffers with you in that particular business. Right now, we're looking at a general contractor in Florida. We're trying to buy right now. So that's not something that's in the fund's mandate, but we thought it was such a great business. I mean, it's a $50 million business. We feel like it's something we want to invest in, and we're going to use it as a platform, possibly to acquire other types of businesses that relate to that particular business. So there's always that opportunity that where we could invest outside of the fund if the opportunity is compelling enough. I don't want everyone to think that, okay, well, I'm going to go, I found a great, portfolio of strip clubs and it's cash flowing, and yeah, okay, we're not going to invest in something like that. I mean, it's really got to be something where it's like it's trades related still, for the most part. Even and it can have that commercial industrial component to it. But anything that's kind of like weird, like chicken farms or salmon farms or something, MLM companies. Yeah, I just don't want you guys to get the wrong idea. Oh, well, it's great, it's cash flowing. Maybe they'll consider this. No, it's still got to be related to what we do, even though it may not be in the home per se.
Gotcha. So I'm going to follow up on that. So how does the manufacturing, whenever you choose on the manufacturing, does this need to be like related? Do these manufacturing? I just got a list of the companies that you guys are actually like kind of like vetting and that kind of stuff right now, and doing a sim analysis and all that kind of stuff for me. So are you mainly looking at when you do that for manufacturing, is it mainly related? Okay, it still needs to be related to the home services, that kind of thing. Is that mainly where you're focused, even with manufacturing, or is there a different thesis there?
No, there's a different thesis. So if you looked at this list here, I mean, most of this doesn't have anything to do with home servicing. Now, there's some
Right. That's
manufacturing
what
or
that's
home
what I was like.
services.
Routers, like PCB boards, that kind of stuff. That's very different. Yeah.
Yeah, and when I say routers in there, it's really router machines, not necessarily like
Okay, gotcha.
they're not like
Okay.
not like internet routers.
I was gonna say that's commodity business. That's what I was
Yeah,
wondering. Yeah.
yeah. I mean,
Okay.
yeah. I mean, there are some manufacturing that's related to like the home. Like we love granite companies. We love if you're making cabinetry, like custom cabinetry, constructing
Hmm.
that kind of stuff, countertops, that kind of stuff. That would all be kind of almost like you're selling directly into the home or whatever, or you could be selling to another like a wholesale buyer or whatever. But those we do like, but there's also stuff, and I just wanted to make sure you guys understood that there's stuff outside of that we're comfortable with, especially around like aerospace and defense, and then these kind of like prototype job shops. So,
Gotcha. Okay. Thank you. No,
yep.
this is helpful.
All right. So let's see here. All right. So one thing I want to talk about to you guys about too, and a lot of this kind of comes up when you guys get to IC. We talk about valuation because this is all going to feed into kind of how the fund is looking and evaluating whether to invest or not. I hate that people jumped in late here, but whatever. All right. So one thing, a lot of times we're talking and we're talking on the boards, we're talking on, IC calls. I'm meeting with you guys, or Chip's meeting with you guys one-on-one to discuss deals. By the way, I should introduce Chip. He's on this call somewhere, but I'll introduce him later. Chip is one of our newest coaches, and a lot of you guys will be working with him directly. So you should start to get familiar with who he is. But when we're on these calls, yeah, a lot of times we're always referencing SDE, SDE, SDE. Yes, that's how the brokers present these deals in terms of valuation, because they can actually pump up the valuation. When we're looking at these deals through the fund's eyes, we're looking at it from an adjusted EBITDA standpoint. So there's a difference. Okay. I think some people still get confused by the difference between SDE, EBITDA, and adjusted EBITDA. All right. So EBITDA is just simply, most of you guys know that. It's just simply a calculation you take off the P&L, earnings before interest, taxes, depreciation, and amortization. You just basically take your earnings, add back depreciation and amortization, interest and taxes, and you get to basically your EBITDA number. Okay. And it's supposed to be a proxy for cash flow. Technically, it's not, but I don't want to get on my high horse and start talking about that again. But investors use it as a proxy for cash flow. Okay. So now from there, you want to, when you're looking at these financials, you're looking at SDE. Brokers will usually then calculate SDE, and that's really about owner's benefit. So it's really about the seller's discretionary cash flow. So what they'll add back would be not only depreciation and amortization, they're going to add back the owner's salary, the owner's family's wages, any health insurance that the owner has in the business. They're going to add personal expenses that they're running through the business. And that's all legitimate from an SDE standpoint, because those are discretionary decisions that the owner can make as far as expenses and paying them out of the business. So it's really that owner's cash flow from that standpoint. And it's supposed to communicate, hey, if you buy this business, this is how much discretionary cash flow you will get as the owner. Okay. And that's fine if you, as the owner, are the only person buying the business. Okay. Now you have an investment partner you're working with. Okay. And so you're not the only quote unquote owner in the business, even though technically you're 100% owner because our capital initially is structured as preferred equity, but you basically have partners in the business. Okay. And so when that partner looks at the business, okay, that partner is going to look at the business from an adjusted EBITDA standpoint. And the difference between SDE and adjusted EBITDA is simply, yes, you can add your owner's salary and owner's costs back, but we're basically going to deduct those back out to account for the fact that you would have theoretically a general manager running this business. You're going to probably have some more management, people, professional management people running the business, and of course that depends on the business itself. But let's just say, your owner adds back $300,000 in owner benefit. Well, your adjusted EBITDA number should really reflect the market value of what an owner would, or what a GM would make running this business. So we're going to adjust that number. So that number could be significantly different. It could be, instead of $300,000 in seller discretionary earnings, maybe that number is only now adjusted to 150,000. We're going to adjust out for what market rates of rent are. Okay. And this is actually stuff that you guys should be doing before we even submit the deal to the equity fund. Because obviously they're going to want to do as less work as possible, depending on us to do that work up front. But in essence, there's the difference between adjusted EBITDA and SDE. And I just guys want you to understand that, yes, you can have the owner's salary completely back and all those owner benefits back. And then you value the business based on that. You're going to be basing that valuation on a high level of cash flow that may not be what the adjusted EBITDA number looks like, which means the valuation may be higher than what the fund would warrant it to be. So that's the point I'm trying to communicate to you guys.
Hey, Rich.
Yep.
So I've run into this a lot. And I honestly thought that adjusted EBITDA was literally just another word they were using for SDE.
Yeah.
Because a lot of these guys throw around adjusted EBITDA, and I don't know, I feel like it almost became like a buzzword because I see that more and more often,
Yeah.
like in every freaking sim now,
Yeah.
aside from SDE. But so what you're saying is it's essentially SDE, except you're subtracting a reasonable market salary. Does that sound
That
right? So
that would be
it's SDE, but you're backing out whatever it would cost if you weren't the one doing it. So it's a, like you said, let's say owner benefit with
yep.
benefits and all the money he's spending is 400 grand, but it's
Yep.
150 if you were to hire a GM. You're only going to add back the
Well,
250.
yeah. So I just want to jump in there. It seems like you're saying more than that, though. You're not just saying like a reasonable owner salary and those kind of things. Like you're going to examine also like are there other family members on the payroll and all that kind of stuff? So you're going to examine all that, and that's what you're going to come up with. Um, in terms of EBITDA versus SDE, because yeah, it might just not, it might not just be the GM on the payroll, right? There might be other people that need to drop off that aren't actually doing anything beneficial to the business. I just want to make sure I understand this.
Yeah, that's part of it. So each situation is a little bit different. So James, to your point, yes. So a lot of times when the brokers are listing the SDE, they don't account for the fact that there's someone who eventually would have to place, let's just say a GM would have to step in and you'd have to pay that person. So instead of like, they're going to add back $300,000 worth of salary. Well, wait a minute. First of all, you're either going to pay yourself or you're going to pay a GM to do that job. One way or the other, that money's coming out. So that's not really total owner discretionary for you as the new buyer with your partners. So we're going to have somebody responsible in that role. And usually we're going to base that on a market rate. So let's just say typically what I've seen, you see usually $150,000 that you're going to adjust that owner benefit by. Now, if there are family members in the business, if they're going to continue in the business, let's say you're going to buy the business, and yes, there's, let's say, the two sons, and they're both like technically oriented people, or one's in sales, and they both want to stay in the business. Then for them to add all that stuff back is not right. Obviously, they're going to continue into the business, so we need to basically subtract that back out if they did add it back. So in essence, what we're trying to get to is what that sustainable number looks like with a manager in place and with all the necessary staff in place. Okay. And obviously, then we're going to account to make sure that there's a market if the seller owns the property, okay, and maybe they've been either charging the business a small amount to show this great cash flow in the business, or they've been overcharging, so we have to adjust for that, or they haven't been charging at all. We're going to make adjustments in the numbers, obviously, to carry forward to see what that sustainable cash flow looks like. So in essence, the adjusted EBITDA, just think of adjusted EBITDA as the sustainable cash flow for a normally managed business, which a lot of these small businesses aren't. They're run by the owner, and they're used as a piggy bank. So, yes, we'll allow all the add backs back for all the personal expenses that'll go away when the owner goes away, but we're going to adjust for having the necessary amount of people in the business. So when we look at it, you're going to, if you're the GM, that's fine. We're going to adjust for the GM. You're still going to pay you. So we're going to adjust for that. If you're hiring a GM, we're going to adjust for that. Okay. If you're going to hire a GM and you're going to stay in the business, which obviously we want you involved with the business, so maybe that's maybe that's unrealistic. But let's just say that both of those are happening. We're going to adjust for that. So the idea is that just understand that SDE is not the same thing as adjusted EBITDA, and when we value the business, we're going to be looking for the actual adjustments that make sense. So while a lot of what ends up happening is what you end up seeing a lot in these deals is, okay, the intrinsic value model told me to pay, don't pay any more than 3.5 times SDE for this business. Okay, that's great. If you're buying the business on your own, that's the perfect answer. And that model works for that. If you're buying the business with an equity partner, whether it's us or someone else, you have to make adjustments for that it's not SDE now. It's the adjusted EBITDA, because you don't want to be overpaying given that the fact that you're going to have additional cash flow coming out of the business. And that isn't necessarily at your discretion.
Is the and that answers my question. So I guess my question was really, so we're still adding back all the extras, right? All the whatever discretion, all the stuff that they got as an owner, right?
Mm-hmm.
But then we're just subtracting back out again our pay or GM pay, and that's completely fair. Now, when you're saying multiples and all, so typically what I've been doing, I don't even multiple. You know what I mean? Like
Yeah.
I just have essentially been going by whatever my debt service coverage can be, right?
Hey,
So
yeah,
I try.
actually, that's a smart way to do it.
So I know like the fund, right, is 1.8, right? I think it is, or maybe a little bit lower
Well,
depending on
I'm gonna get into
that's probably
those
coming up.
specifics. You'll actually
Okay.
be pleasantly surprised, but I'll get into those specifics as soon as we get past this part.
Okay,
But
yeah,
yeah,
so that's coming up.
that's a
I'll
smart.
hold that.
Yeah, that's a smart way to look at it. For all of you who didn't follow necessarily what James said, really, if you're going to take a valuation approach to what you should be buying the business for, then you should run the numbers through your SBA calculator to see kind of if the price can support the loan, if you're reaching a minimum debt service coverage based on what you want to hit, how much cash you want to take out of the business, what your post debt cash flow looks like, and then you back into the valuation. Okay, I'm willing to pay this amount for the business, given what this scenario looks like, versus just playing a blind multiple on the business. I think I said it a year or two back. I hate I don't hate multiples. I know where they're used for, but that's more of a sell side tool than it is a buy side tool. Buy side, you need to plug in your inputs to see if it matches your investment thesis and matches your investment parameters. And if it does at that particular multiple, then it's worth buying. If it doesn't, skip it and move on. So I hate for people to always fall into the multiples trap, but I guess that's how the game is played on the sell side. So, you kind of have to adjust to it. Troy?
No, I just wanted to
Yeah.
say, like, I just want to jump in and say, like, this is really helpful. This entire conversation is really, really helpful. So I just want to say thank you to both of you for having this conversation and this question and answer, because that's actually a really helpful learning tool for me. Thank you.
No worries. Glad we can do that for you. Troy?
Yes, sir. Thank you. So I ran across an interesting one, and I just wanted to get your take on it. So it's basically a guy was he's working full time, and then he had a part-time business on the side, and then it ran like that from like 2017 to 2021, and then 2022 he retired and then ran it full time, and then it kind of ramped up from like, call it 300 grand SDE to like a little over $1 million SDE during that time frame.
Mm-hmm.
How do you guys think about like, because and then they kind of did like the way that it's currently priced is sort of a blend in between like a 300 grand a year and the 1.2
Yeah.
year. So like off of the current year EBIT or SDE, it looks pretty great. But like, how do you guys think about that?
All right. So I'll answer that, and then we'll kind of move forward with this. But generally, the way you should look at it and the way we will look at it is based on that last year. We'll try to understand exactly what the revenue drivers were and whether those drivers are sustainable. If it's sustainable, then we'll give them, credit for that last year. I mean, if he hasn't been working in the business full time, and all of a sudden he jumps in full time, and all of a sudden he's doing over $1 million, and that can transfer to you as the buyer. And there's like no special effort required, like no specialized knowledge. Like he's got some trick up his sleeve because he knows, the pastor's sister's uncle, and there he's getting all of his business from there. And if that's if he can transfer that relationship with you, hey, we'll count that. But if it's a sustainable number, it's all good. I mean, that works. And if they're pricing it between the 300,000 and $1 million, then you would actually be giving yourself a deal, given that you can continue with $1 million from that standpoint.
Yeah.
So
Okay.
that's how we would look at it.
I am curious why the equity fund doesn't look at free cash flow, considering how important the working capital
We do
peg
look at free
calculation
cash flow.
is.
We do
Okay.
look at it at some point. Yeah.
And the capital
in the
intensity.
analysis, we will look at it because obviously it's important from a payback perspective.
Got it.
All right. So one of the criteria, you guys might want to write this down, that you guys should understand is we don't like businesses that are valued at more than 4 times the adjusted EBITDA calculation that you come out to, or that we've calculated, or you've calculated, or what have you. So in other words, the total purchase price should be no more than 4 times adjusted EBITDA. Now, total purchase price, what does that include? Total purchase price not only includes the purchase price, but you also have to consider any overfunding costs that you include in the deal, because those overfunding costs could eat into your cash flow. So the total purchase price is really going to be your total, what I call total project costs. So it's the purchase price plus the, you know, let's say purchase price. You're gonna probably have, let's just say let's say a $3 million deal. Typically, purchase price, you're probably gonna overfund it with $200,000 for other costs or what have you. So let's just say that total purchase price is about $3.2 million. Okay, if you take that divided by your adjusted EBITDA number, it should still, your purchase price should come in at less than 4 times that adjusted EBITDA number. Does that make sense?
Yep.
Does not include real estate, right? Ever?
Yeah, that's separate from real estate. Real estate's a different animal. I'm just looking at business value right now. Okay?
Yeah, that makes sense.
And so total cost of SBA2, including the PG.
Yeah.
So how did the Forex number come up?
That's just kind of how the math
Yeah.
works in terms of the implied returns.
Okay.
Yeah, that's typically how it works. Okay, so now a lot of you have heard in the past 1.8 for the fund. Okay. In terms of debt service coverage. Everyone knows what debt service coverage ratio is, right? Okay. Should learn that. If you don't, make sure you get through your training so you understand it. All right. So what the fund is looking for really is at least a 1.5 debt service coverage ratio even once the seller note is activated in the deal. So if you have a seller note, let's just say that's 2 years deferred, okay? And then all of a sudden within that 2 years, it clicks on, when we look at your projections, okay, that debt service coverage number still has to hit at least 1.5. Okay. So in the beginning, we always recommend you come in at a 1.8. Okay. So I'll say this. If you come in at 1.8, that gives you some room to get to 1.5. If you come in at 1.7, probably still gives you some room. If you come in at 1.6 or 1.5 from the beginning and you got a seller note, which we actually require in the deal anyway, if you come in at that level already, you're already behind the gun. Yeah, at the beginning, yeah, but Rich, the seller note is fully deferred, so it's at 1.5. Yeah, but when it's not deferred, it won't be at 1.5 unless you're going to tell me that you're going to grow the business X amount of percent over the next 3 years. And if you have a home service related business, and you're telling me you're going to grow at 20% per year over the next 5 years, I'm going to call you on your bull. Okay. It's a commodity business. Yes, you can grow the business through marketing, but typically you're looking at 5-7% growth rates at the most on a business like that, unless there's some extenuating circumstance around that business or some market issue, structural market change, which will allow you to grow it significantly more than that. So just keep that in mind. Post seller note activation, and what we'll look at is kind of worst case scenario for the note, meaning principal and interest, not just interest only, because you're probably only going to have interest only for a couple of years before the whole note starts to kick in terms of P&I payments. All right.
Rich, question regarding that. So what is and you might not even, you probably do off the top of your head. So what's the IRR for the fund at that level, like a 1.5? Generally,
I mean, I don't know it off the top of my head, but
what do you guys expect? Are you guys expecting like a 30%
yeah,
or
it's
a
generally
minimum?
running 33, 35%, somewhere around there.
Gotcha.
All right. Here's a non-quantitative measure. You're buying a business, and you want our money, you better be prepared to move to that location. Again, we're not buying part-time, we're not investing in part-time owners. So if you choose to buy a business in Missoula, Montana, and nothing against Montana, I don't like the University of Montana since they're one of my conference rivals from football. But if you're choosing to move to Missoula, Montana, or buying a business in Missoula, Montana, you better be prepared to move to Missoula, Montana. We have an agreement with our LPs that our AEs are running the businesses actively, and they're there at that location. So no buying a business in Missoula and wanting to live in New York. That doesn't fly. Okay. So just keep that in mind when you're out there looking at businesses. Keep in mind, would I want to live in this town or would I want to live in this city? And there's nothing wrong with small towns. We've invested in businesses in small towns in Arkansas, Idaho, Montana, as a matter of fact. So there's nothing wrong with a small town if the business is good and it's got a wide enough market there. But you have to be prepared to move there.
So how long is relocation, the whole time or just the first year?
You're gonna have to at least be there for the first year. Wink,
Right.
wink, nod, nod. Because even with the Ace team there, you're gonna have to be on the ground running the business, understand the business. You're gonna be involved in all aspects of the business, and then as you start to bring in professional management after you've been there for a year, yeah, I mean, there's some room for you to, you know, move back to where you want to go as long as you've got a solid management team in place and a way to actually govern the business from your location. But I would say, initially you need to be there and plan on being there for a year. More likely, you're going to end up being there for 18 months, 18 to 24 months, but plan on being there for at least a year.
Yeah, so I have a question about that because I live on the East Coast, in Charleston, South Carolina. So, like, it's pretty easy for me to get to anywhere from like Savannah to Atlanta to Charlotte and those kind of things. So, when you say relocation is necessary, I like if I can say, hey, I'm going to be in the office like, you know, three 3 days a week or something like
Oh,
that. Is
I
that
wouldn't.
some
I
like,
would
yeah,
not.
yeah,
I would not say that to
yeah, go
Chris
ahead.
on your interview with him, because you guys will ultimately have to do an interview with him. Like I will initially sell the deal to him, which will kind of get you to the
Yeah.
next stage. But if your interview, as soon as he starts hearing, I'm going to be there, 3 days, he's all of a sudden in his mind's going to be like, yeah, he's going to tell me that, but he's only actually going to be there one day, and then it's not going to go well.
Right.
So, I would say 5 days and then fly home for the weekend, Friday afternoon, Friday night, and then be back in the office on Mondays.
Okay,
Um,
gotcha.
that's just the
Yeah,
expectation. Now, that's the
yeah.
expectation. I don't know, if you can get away with something else thereafter, that's up to you guys. But I'm just letting you know what the expectation is from the fund.
No, I mean this is going to be my full-time job. I was just curious about whether or not like because the East Coast is densely, especially along the coast, densely populated. So there's
Yeah,
some things that are in easy driving distance and that kind of stuff, and we're like I can be there. Like I could be there 5 days a week, or I could be there, whatever. And so that's why I'm just trying to figure out the geographical location
yeah.
that would work. So
I would say, but just assume 5 days a week for that first year at least.
yeah, okay, makes
Rich,
sense.
what is acceptable like driving distance? Like 2 hours away?
Yeah, I mean that's reasonable. I mean, if you can
Okay.
drive there every single day,
Yeah.
that's a lot
Yeah,
of
it
time on the
sucks. That
road.
would suck. Yeah.
Yeah.
Okay.
All right, and this kind of relates to that full-time active dedication and active management of the business. Obviously, if you're there every day, you're relocating. We assume that you're going to be in the office every single day running the business. Now, one of the benefits, obviously, of business ownership is you want to build a business where you don't have to be there every day. Eventually, you'll get there, but again, from the fund's perspective, that first year, we want you full-time in the business and dedicated to the business because obviously you're the steward of our capital and we're the steward of our LP investors' capital. So we want to make sure that, everything is all kosher on that front.
Yeah,
All
no, it
right,
makes sense. I mean, you don't want part-time owners, right? You
exactly.
want yes, yeah, it makes total sense. So
Exactly. All right. So this real quick, and we may go over by a few minutes. So Ben, if you're on the call, I know we have a call thereafter, but we'll just kind of have it afterwards. Um, Okay, proposal on how the AE will pay back the investors from free cash flow starting from after year one. Okay, so one thing about this, yes, you guys are building your models, and usually what I'll do is I'll append a model onto your model based on kind of what your model's data has to show Chris kind of what that payback looks like. You guys typically won't see that model, but you have to have you have to show some sort of a plan from the get-go on how investors are going to be paid back. And I'm going to show you guys something real quick. And it doesn't have to be overly complicated, but he needs to understand exactly where the cash flow is coming from, what the working capital needs are in the business, how that money is going to flow out to investors. Let me share something real quick with you guys. And this will be all right. Let's see here. All right. So and don't this is you don't worry about the content of this, but I just kind of want you to focus on a couple different areas here. Um, so obviously, and really I'm on the from the H side over. Don't worry about what's on the other side here. Um, Obviously, we're looking to understand exactly kind of where the business, and really I'm looking at this line, adjusted EBITDA number down. Okay. If we're looking at kind of like growth rates in the business, understanding what the adjusted EBITDA is, what the kind of debt service looks like. And what we're really trying to assess is where the cash flow is going to come out over a certain amount of years here. Okay. And then understanding kind of what the dividend, and this again, don't worry about the numbers here 50%, 50% each. Yeah, that's irrelevant here. All I want you guys to understand is we're looking to figure out exactly how we're going to get paid back. So I'll do an analysis and I'll take your information and I'll plug it into this model and show Chris. But you guys need to be comfortable understanding exactly how this works. Okay. And a lot of this will be driven by the terms you get. But initially, we just want to see what the bottom line cash flow looks like. And then we'll set the terms and then provide you with a final model of what the payout might look like for you over the next few years based on those terms. But initially, we're trying to get to really the only number here that we're really trying to get to right now at this point is going to be this number here. And kind of what that, well, actually, we're not trying to look to that. We're actually looking at this number. So we just want your model to explicitly lay out exactly where we're going to be in terms of EBITDA over the next 5 years. Because, if you put in some assumptions, some general assumptions, your debt service is too high, your expenses are too high or what have you, and we don't understand how we're going to get paid back from basically year one on, it's a no-go. Okay. So build your model, understand where the cash flows are coming from, make sure it works for you. Make sure there's at least, again, we're looking at, I don't know that there's an absolute number from a cash flow perspective. We are initially looking at an absolute number, honestly. And if it dips below that number, and I'll actually share that with you real quick. If it dips below that number, if it's a temporary dip because you're investing in the business, that's one thing. If it's obviously, hopefully guys don't supply a forecast that shows a downward trend in cash flow, but if you show us something like that, that leads to more concern from that standpoint. Let's see here. Oh, I'm almost done, guys. So I know it's Friday. So some of you guys, it's Christmas holiday weekend. So I know you guys have some time here. Let's get back to here.
Rich, I do have a question for you when you're ready.
Yeah. Go ahead, real quick.
Okay, are you guys paying out in tranches? How are you actually paying out the distributing the capital once somebody is approved? Is it in tranches or how is it done?
No, it's all one time.
Just all in one
So
time. Okay,
once we agree to fund the deal at the close, once your SBA loan hits, our capital will be deposited the same day.
Okay, that's awesome.
Yep.
Okay,
so
thanks a lot.
Another requirement you guys have to get in the note or in your structure is we need to have at least a 10% seller note or a rollover of seller equity of 10%. That's just we want to see that. It really is about tying the seller to a certain extent to the business, making sure that they're not going to get their money and just leave you high and dry. 10% is significant for them. So we want to at least see that amount in there. Now you can have a 20% seller note if you want. That's even better. But we definitely want to see that in the business or in the offer structure. All right. Now this is probably this is the last screen. We'll talk about this. This is kind of important. I'm going to kind of blast through it because we don't have a whole lot of time. But this is probably the most important part of you getting approved for equity with us. Yes, it's important that you move to the location. Yes, it's important that you're full-time in the business. Yes, we do have a requirement for 10% seller note financing. Yes, we want 1.5% or 1.5 debt service coverage. All those are, black and white, plain, can be applied to any business. This part of it requires a little bit of thinking on your part and a little bit of selling on both of our parts. Okay. So you're going to have to write a business plan. That's going to be a requirement for the fund. It's if you can't write a plan, literally you could go to that Plan Pro or whatever online thing, spend $20. They have sample plans for different industries. Take one of those plans, adapt it to the business that you're buying with your thoughts on how you plan to basically run this business. Okay. So it's not super difficult to write a business plan. Okay. The main things we're going to be looking for. If the business has under $2 million in adjusted EBITDA, we're looking to see how you plan to get there over the next 5 years. Okay. What steps are you going to play? It's got to be a realistic plan. It's not something where you're going to simply plug and play growth projections into a model and tell us, oh, this is how I'm going to get to 2 million. It's got to be well thought out. Your cost to get there, how many people you're going to have to employ, what's your sales and marketing strategy, what's your operations plan. You need to think through those issues. Okay. Again, you got to have a clear plan for the licensing transition. If there's an issue where you're buying a business, you don't have a license in the business, what is that plan? Okay. Is there someone else on staff there that has a license or can sit for the exam to get the license? That's fine. If the owner is going to stay on for 2 years while you deal with the transition, the license issue, that's fine. Do you have the ability to hire someone into that role that can bring their license? That's fine, as long as it's realistic from that standpoint. One of the most important things you're going to have to sell to, and I'll help you come up with a strategy, but we're going to have to sell to Chris is, what's the recurring revenue strategy opportunity? So when I talked to him earlier about project-related businesses, construction businesses, that sort of thing, okay, those are great. You can have 1 year where you're doing great in terms of your revenue, but then the next year your revenue falls off a cliff. Okay. What's your recurring revenue strategy around the business that you're buying? How are you planning on obtaining new customers? How are you planning on reducing customer churn? Are you planning on installing maintenance contracts or warranty services or whatever? How are you going to build recurring revenue? How are you going to get repeat referrals in the business? You've got to be able to articulate that strategy, because one thing we're doing is we're investing passively. So part of what we want to see in place is a way for those revenues and those profits and that cash flow to be sustained for the whole time that we're in the investment. Okay. And part of that comes from that recurring revenue strategy. If it's a situation where you have to go out and actively sell a project every single day and you're only winning 25% of those bids, that scares us. Okay. But if you can win a bid and you can build a service around winning whatever, like let's say it's you're a construction plumber, you're installing the plumbing, can you sell a service agreement with that plumbing to the new owners of the properties if it's like if it's a new development or something like that? Or can you sell any other type of service contract to the ultimate end buyer of that particular property? So we're looking for things like that. And then obviously, as you're going through the process, you're going to meet with the ACE team during the acquisition process. And what Chris is going to want to see is some sort of, and this is going to really fall to your ACE rep. So this isn't so much you, but you should be involved with this. There's a gap analysis, meaning like when the ACE team comes in, where are the gaps in the business? What's the plan to fill those gaps? And what's the timeline around that? And you'll be working actively with your ACE team on that. And then he's going to want to have a discussion on competitive advantage. Like what makes the company different than the next XYZ company that they're competing with? What are you going to do differently that's going to attract customers to the business? And don't worry about a brand analysis. That's just it's a competitive strategy, a framework for basically analyzing, different aspects of the business, like where you can provide the most value, where there's no competition. What can you do to move competition out of the market? I don't worry about that. But if you know how to do a brand analysis, you'll get extra points with Chris because he loves those for some reason. But these are kind of some of the things I want you guys to think about as you're requesting equity in the deal. So it's not simply a matter of coming in, finding a great business, and then just because it hits some of the metrics, you think you're going to get an investment. No, there's more to it than that. There's no right to equity, but we will try to provide equity where we can to businesses that we really like and where we think the AEs are really strong from that standpoint. But that's it for today. I would take questions. Go ahead.
Oh, can the 2 million be inorganic, or does it have to be organic?
Well, it can be inorganic, but you just got to be able to explain and articulate where you're going to get the capital to actually grow, to acquire other businesses. If you can use your cash flow and you can lay that out, if you're going to grow your business enough to where you've got enough cash flow to then take that cash flow and pyramid into another acquisition, that's fine. If you can take your cash flow and somewhat safely leverage it up through another SBA loan and acquire another business, that might be fine too. If you're going to go buy another business and you're going to ask us for the lion's share of the equity capital to go buy that other business, that ain't going to happen. But there's ways, yeah, it can be inorganic. You just need to be able to articulate the strategy.
Got it. Okay.
Yeah. All right, y'all. Go ahead. One last.
Sorry. I know you got a meeting. So when you're saying acquire another business, this might even be too much of a question. You're saying acquire another business. We've talked about this kind of briefly. If we're using our own money and how, let's say the fund owns 20%, we own 80%, and then we're using our own cash and we lay out a plan to say acquire another business, right? Does the fund participate in that too, or what if we wanted to do it ourselves and we didn't need the fund for that?
Then you wouldn't roll it up under their current business.
You just do it as a whole separate.
Yeah, do it as a separate business. Yep.
Okay. But if we wanted to say do an add-on, right, or a bolt-on or a tuck-in or whatever you want to call it, and it emphasizes the current business and it makes sense, then the fund, I guess, would have to participate in some capacity if they wanted to.
The fund would want to, they'd want to participate from that standpoint. So
okay, perfect.
Yeah.
Awesome. That was my only question. I appreciate it, Rich.
All right, no problem. All right, you guys, thanks for jumping on, and we will have a call next week, I think. So don't know what the topic will be yet, but it'll be something interesting. So have a Merry Christmas, everyone, or a Happy Holidays for you who don't celebrate Christmas.